You mentioned that there's $1 trillion in credit card spending, the highest ever. I heard that data as well before. Tell us about the dangers of that as Americans, right? So let's go a little bit to families and individual, and then let's look at the country.
So the way credit card debt impacts everyone that's listening to this and everyone around us is the following. Right now, as these short-term interest rates rise, you hear the news, again, doing a really bad job of reporting, but the news likes to say when the Federal Reserve raises short-term interest rates, that mortgage interest rates go up. When in fact, the data shows those are completely opposite. When they raise short-term interest rates, actually, traditionally speaking,
Right.
the mortgage rates start to come back down. Now, what does go up immediately are credit cards and auto loans and home equity line loans, mainly because two of those three, credit card and home equity lines, which are essentially the exact same tool, those are variable rates, meaning that they are not fixed and adhered to more than an introductory time period that's offered to you. You may see credit cards in the past say 0% for the first 12 months. Well, that's because they're locking you in at 0% for 12 months. But after that, it's going to adjust to the current rate of that credit card. In this particular case, in this market, you're not really seeing 0% anymore. And that's because the short-term rates are so much higher that you're seeing the average rate inside that report that we were just describing in the PCE is at 20% right
Yikes. Whoa.
now. 20%. Now, to
Holy
put
crap.
perspective for the audience, the way credit card interest works is it's an APY. It's not an APR. So, pardon me. So because of that, you get your interest rate expressed. And if you go to your statement online or when you get it in the mail, you should definitely go to the statement and read the portion that says your daily periodic rate. And what they do is the credit card company will take that APY and they'll take that 20% and they'll calculate that. And depending what state you're in, there's a cap on the interest they can charge. Most states will cap at 24.99. Some will allow them to go to 29.99. But depending on what state you're in, they'll give you an APY and then they'll give you a daily periodic rate. That daily periodic rate is a compounding rate of your balance every single day. And that's why they call it an APY, not an APR, because what's going to happen is you're going to end up spending a hell of a lot more than that 24.99 because it's a compound. Like, compounding works for you and it can work against you.
Against you. Yes,
With
sir.
a credit card, it is absolutely working against you if you don't pay it off. And the dangers of not paying that off is this.